Most people hear that Treasury yields are rising and assume this is simply a Wall Street problem, something happening on a trading screen, somewhere between bond desks and investment banks. But if you are a homeowner, a first-time buyer, a worker saving for retirement, or a retiree living partly on investment income, that assumption can be costly, because when the U.S. government has to pay more to borrow money, the consequences don't stay inside the Treasury market. They can move into mortgage rates, corporate borrowing costs, stock valuations, government interest expenses, and eventually the financial decisions households make every month. And right now, that connection is becoming much harder to ignore. The 30-year U.S. Treasury yield recently climbed above 5.3%, reaching its highest level since 2007, while the 10-year yield moved toward 4.75%. Reuters reported that investors are demanding higher returns, partly because of concerns about the enormous amount of U.S. borrowing, inflation risks, reduced foreign demand, and the possibility that interest rates could remain elevated for longer. At the same time, the average 30-year mortgage rate was around 6.7% in mid-August, and housing activity is weakening. July housing starts fell 12.4% from the previous month, considerably more than economists had expected. So the real question isn't whether Treasury yields are high. The real question is what this environment means for your financial life. And once you see how the pieces connect, you'll understand why a number on the Treasury market can influence the price of a home, the value of a stock portfolio, the return on your savings, and even the choices you make about retirement. Let's start with the most important distinction. A Treasury yield is not the same thing as the Federal Reserve's policy rate. The Federal Reserve controls short-term monetary policy. Treasury yields, particularly longer-term yields, are determined by the bond market. Investors are constantly asking a simple question. If I lend the U.S. government money for 10, 20, or 30 years, what return do I need to justify taking that risk? That required return can change because of inflation expectations, government borrowing, economic growth, global interest rates, demand for treasuries, and expectations for future Federal Reserve policy, and that is why you can have a situation where the Fed is not aggressively raising short-term rates, yet long-term Treasury yields still climb. That's exactly the distinction households need to understand. This isn't necessarily one dramatic policy change. It is a structural shift in the cost of money. The United States is borrowing on an enormous scale. Reuters reports that the national debt is approaching $40 trillion, while the federal deficit remains large. Investors are therefore paying closer attention to how much debt the Treasury needs to issue and what return investors will demand to absorb that supply. Think of it like this. If the government needs to borrow more, and investors become less willing to accept low returns, the government has to offer a higher yield, and when the world's largest borrower has to pay more, the rest of the financial system doesn't operate in isolation. Now let's translate that into something much more familiar, your mortgage. If you're shopping for a home, you may already know that mortgage rates don't simply move one for one with the Federal Reserve's overnight policy rate. Long-term mortgage rates are heavily influenced by longer-term bond yields and market expectations. That is why a surge in the 10-year Treasury can put upward pressure on mortgage rates, even if the Fed isn't moving at the same pace. As of August 13th, Freddie Mac's weekly survey showed the average 30-year fixed mortgage rate at 6.67%. Other market readings around August 18th placed the national average around 6.7%, with some measures showing rates moving higher again as Treasury yields climbed. Now consider a hypothetical $400,000 mortgage. At 5%, the principal and interest payment is roughly $2,147 a month. At 6.75%, it is roughly $2,594. That's about $447 more every month. Over a year, that's more than $5,300 in additional principal and interest, and that doesn't include property taxes, homeowners insurance, maintenance, or other costs of owning a home. This is why a relatively small movement in interest rates can dramatically change affordability. The important point is that this doesn't necessarily mean home prices must collapse. It means buyers have less purchasing power. A household that could comfortably finance $450,000 at one interest rate may only be comfortable financing substantially less at a higher rate. That changes what people bid. It changes what builders construct. It changes how long homes stay on the market. And eventually, it can change where capital flows throughout the housing economy. We're already seeing evidence of pressure. July housing starts fell 12.4%, while builder sentiment remained weak. Reuters reported that the August Home Builder Sentiment Index was only 35, and builder confidence has remained below 40 for 16 consecutive months. For someone trying to buy their first home, the lesson isn't wait for a crash. The lesson is more practical. Don't calculate affordability using the maximum mortgage a lender says you qualify for. Calculate it using the payment you can comfortably carry if rates stay elevated, taxes increase, insurance rises, and one unexpected expense appears. That is a completely different calculation. Now let's move from housing to stocks, because this is where the Treasury yield story becomes more complicated. Higher yields can actually be good news for certain savers. If you can earn a relatively attractive return from high-quality government debt, cash-like instruments and bonds become more competitive with stocks. Imagine an investor deciding between a risky investment expected to produce an uncertain return and a relatively low-risk government security offering a much higher yield. The higher the risk-free rate becomes, the higher the potential return investors may demand. Before taking additional risk, that affects stock valuations, and the impact can be particularly important for companies whose profits are expected far out into the future. This is one reason technology and growth stocks can become more sensitive when long-term yields rise. It isn't necessarily because those companies suddenly became bad businesses. It's because the mathematical value of future profits changes when the discount rate changes. That's a concept that sounds complicated, but the household version is simple. A dollar you expect to receive 10 years from now is worth less today than a dollar you receive today. And when interest rates rise, the value assigned to distant future cash flows can fall further. That's one reason higher Treasury yields can put pressure on expensive growth stocks, even when the broader economy is still growing. We've already seen that tension. On August 18th, U.S. stocks declined, with the S&P 500 falling about 0.7% and the Nasdaq dropping about 1.3%, while semiconductor shares were hit particularly hard. But here's where you need to avoid a common mistake. Higher yields do not automatically mean sell stocks. That is the reactive approach. A long-term investor should instead ask a much better question. What role is each investment supposed to play in my financial plan? If you are 30 years old and saving for retirement decades away, a temporary shift in bond yields should not automatically change a diversified long-term strategy. If you're 62 and planning to retire next year, the same market movement may matter much more because you have less time to recover from a major decline and may need to begin drawing from your portfolio. This is where age and timing become critical. The same market can be almost irrelevant to one household and extremely important to another. Now let's talk about the part almost no one wants to think about: retirement. Higher Treasury yields create a strange situation for retirees. On one hand, higher yields can provide more attractive income opportunities from high-quality fixed-income investments. That can be helpful for someone who needs predictable cash flow. But on the other hand, rising yields can push bond prices lower, and remember the relationship. When market interest rates rise, existing bonds with lower fixed coupons generally become less valuable in the market. That doesn't mean every bond investor permanently loses money. If you hold an individual treasury to maturity, and the issuer makes all required payments, the price fluctuations along the way may matter much less. But if you're holding bond funds, need to sell at an inconvenient time, or have a portfolio heavily concentrated in long-duration bonds, rising yields can create meaningful volatility, and this is where most people get caught. They think of bonds as safe without asking what kind of bond exposure they actually own. A short-term treasury, a long-duration bond fund, a corporate bond, and a high-yield bond can have very different risk characteristics. Safety isn't a single word. It's a structure. Now consider the broader retirement picture. If you are nearing retirement, you may have 3 different financial pressures arriving at the same time. Your living costs can rise, your investment portfolio can fluctuate, and borrowing costs can remain elevated. That's why retirement planning cannot simply be a question of, how much money do I have? It has to become a question of, how much reliable cash flow can my assets produce? And how much flexibility do I have? That distinction becomes incredibly important during periods of elevated rates. Let's say you're 58 and hoping to retire at 62. You don't necessarily need to panic because the 30-year Treasury yield crossed 5%. But you should examine whether your retirement plan depends on selling large amounts of stocks during a bad market. You should examine how much cash you need for the first 2 or 3 years of retirement. You should understand what portion of your portfolio is exposed to interest rate risk. And you should know how Social Security fits into the overall income plan. Social Security isn't directly determined by the Treasury yield, but the broader economic environment matters because inflation, government finances, interest rates, and household spending all influence the financial conditions surrounding retirement. And if you're still working, this is also where taxes enter the picture. A higher interest environment can create more interest income. It can also change the attractiveness of different savings vehicles. But don't make investment decisions simply because something offers a higher headline yield. A higher yield is compensation for something. Sometimes that something is duration risk, sometimes credit risk, sometimes inflation risk, sometimes simply the opportunity cost of locking money away. The number after the percent sign isn't the entire story. Now we reach the tension point. Here's the part almost no one talks about. The biggest risk from higher Treasury yields isn't necessarily that rates stay high for 1 month. The bigger risk is that households start making decisions based on the assumption that rates will quickly return to the unusually low levels many people became accustomed to. This is where financial planning can quietly go wrong. A buyer stretches for a house because they expect to refinance later. A retiree takes on unnecessary debt because they assume rates will fall soon. An investor abandons stocks because bonds suddenly look attractive. Another investor does the opposite and takes excessive risk because they don't want to miss the next rally. All 4 decisions are reactions to uncertainty. The strategic household does something different. It plans around what it can control, because the future path of Treasury yields is uncertain. The path of your own spending is something you can actually influence. And that leads to 2 very different financial paths. The reactive household constantly asks, what will the Fed do next? The strategic household asks, what happens to my finances if rates stay here for another 2 years? That second question is much more powerful. If you're a homeowner with a fixed-rate mortgage, rising market rates may have little immediately impact on your monthly principal and interest payment. In fact, if your mortgage rate is significantly below current market rates, you may have an asset that is economically valuable even if you never think about it that way. If you're renting, however, higher financing costs can influence housing supply, construction activity, and landlord economics over time. If you're carrying variable rate debt, higher rates can hit your cash flow much more directly. And if you're a saver with substantial cash, higher yields can finally give you more opportunities to earn something on money that doesn't belong in the stock market. That's the important contrast. The same interest rate environment creates winners and losers depending on balance sheet structure. Now imagine you're 30 and renting. Your priority isn't predicting the next Treasury auction. It's building an emergency fund, managing high-interest debt, maintaining a strong credit profile, and investing consistently for long-term goals. If you're 50 and behind on retirement, your situation is different. You may need to focus more heavily on savings rate, debt reduction, tax-efficient contributions, and the timing of future Social Security. If you're 62 and considering retirement, your biggest question may not be whether stocks rise next month. It may be whether your guaranteed or relatively predictable income sources cover enough of your essential expenses, and if you're already retired, sequence of returns risk becomes increasingly important. A market decline early in retirement can have a much larger effect than the same decline later, especially if you're withdrawing from your portfolio while prices are down. That's why cash flow planning can be just as important as investment selection. So what can you actually do this week? First, calculate your true housing affordability. Don't use the lender's maximum approval. Add the projected mortgage payment, property taxes, insurance, maintenance, and any association fees, then stress test that number at a higher interest rate than today's rate. If the payment would force you to cut retirement contributions or eliminate your emergency savings, the house may simply be too expensive. Second, check your debt structure. Make a list of every debt you have and identify which rates are fixed and which can change. A household with a low fixed mortgage and no expensive revolving debt has a very different exposure to rising rates than a household carrying large variable rate balances. Third, review your retirement portfolio by role, not just by percentage. Ask which investments are intended for long-term growth, which are designed for stability, and which are supposed to provide near-term spending money. If you cannot explain what each part of the portfolio is supposed to accomplish, that is a good place to start. Fourth, don't confuse a higher yield with a free return. Before moving money into a bond or fixed income product, understand its maturity, liquidity, credit exposure, and tax treatment. A yield is only useful if you understand what you're receiving in exchange for it. Fifth, if you're approaching retirement, run your income plan under more than one scenario. Don't calculate retirement based on one expected market return. Run a conservative case, run a moderate case, and consider what happens if inflation stays higher than expected, or your portfolio falls early. In retirement, you don't need to predict the future. You need a plan that can survive several versions of it. Sixth, review your cash reserves. Higher yields can make cash and short-term government securities more useful than they were when returns were close to zero, but your emergency fund should still be based on how much you may need, not on how much interest you can earn. And seventh, don't make a major financial decision simply because today's headline is frightening. The market will continue producing headlines. Some will be correct, some will be early, some will be completely wrong. Your advantage comes from having a financial structure that doesn't require you to get every prediction right, and that's the bigger lesson behind this Treasury yield story. For years, many Americans became accustomed to extremely low interest rates, cheap mortgages, cheap corporate borrowing, low yields on safe assets, high valuations for growth investments. But financial conditions don't stay fixed forever. A 5% long-term Treasury yield doesn't mean the economy is broken. It doesn't automatically mean stocks are about to crash. It doesn't mean home prices must collapse. And it certainly doesn't mean you should panic. What it does mean is that the financial environment has changed. Money has a price again. And when money becomes more expensive, financial discipline becomes more valuable. The United States is dealing with enormous borrowing needs, and investors are demanding higher compensation to finance that debt. At the same time, geopolitical tensions and energy prices are adding another layer of uncertainty to the inflation outlook. That combination is exactly why long-term yields have become so important. But there's another side to this story. Higher rates can reward savers. They can provide better income opportunities for conservative investors. They can eventually bring more discipline to asset valuations. And they can create opportunities for people who have liquidity and patience. The key is not trying to guess exactly where the 10-year or 30-year Treasury yield will be 6 months from now, Nobody knows that with certainty. The key is understanding how your own finances respond if rates remain elevated. Because the strongest households aren't the ones that perfectly predict the market. They're the ones that don't need perfect predictions to remain financially stable. If you're buying a home, leave yourself margin. If you're investing, understand your time horizon. If you're approaching retirement, build around cash flow rather than headlines. If you're already retired, understand how withdrawals interact with market volatility. And if you're still working, use this period to strengthen the parts of your financial life that compound quietly over time: savings, debt management, tax planning, diversification, and consistent investing. That's how you turn an uncertain environment into something you can actually manage. The Treasury market may be sending an important message right now, but the message isn't necessarily run. It's pay attention to the cost of money, pay attention to how much debt you carry, pay attention to how much risk your portfolio actually contains, pay attention to how dependent your retirement plan is on future market conditions. And most importantly, pay attention to the difference between a temporary market headline and a structural change that could affect your finances for years. Because financial security is rarely destroyed by one bad day in the market, and it is rarely created by one brilliant investment. It is built through thousands of ordinary decisions made with enough margin, enough patience, and enough awareness to withstand uncertainty. So here's the question I want you to think about. If Treasury yields stayed around today's elevated levels for the next 2 or 3 years, what part of your financial life would be affected the most? Your mortgage, your investments, your savings, or your retirement plan? Let me know in the comments. And if you want more calm, data-driven explanations of the economic changes that actually affect your household, subscribe to the channel, because the goal isn't to predict every move. It's to understand the system well enough that you can make better decisions when the system changes.